Hey there, and welcome back to Keys of Home Ownership. My name is Josh Jampedro. I'm the leading strategist and vice president of Home Loan Advisors, where we're all about making the home buying journey not just a goal, but an adventure. So today's guest, Chad, brings a fresh perspective as the broker owner of AnchorPoint Real Estate. So get comfy because we're about to unlock some stories and wisdom that could make your journey to home ownership smoother and more enjoyable. So, Chad Damitz, how are you, sir?
Hey, I'm doing good, Josh. How are you?
Doing well, doing well.
Thanks for
Finally
having me
back.
on.
Yeah, finally back here in Tampa. I've had some a little bit of weather issues lately, I guess, to kind of say the least. So
Yeah,
now finally back, and then we get the holidays. So in the real estate industry, you always have two things that you're trying to avoid, which is holiday slowdowns and bad weather. So
and
we get them.
hurricanes, right?
Yeah. So we kind of get them basically all at the same time. Um, so just a little bit of background, what kind of brought you into real estate? What was your journey like kind of moving into this role?
Yeah, great question, Josh. So, my wife and I moved down to Florida in 2016, and I was actually in the process of getting my going to medical school and becoming a foot doctor. And so I was actually traveling to Miami, and this was a couple years later during COVID. And that was when everything shut down, and I was not able to meet with my classmates, because there was just so many restrictions. Long story short, I was commuting every week all the way down to Miami from Southwest Florida. My wife, we just were having our third child, so we were super busy. She just got her nurse's license, and basically, I was going back and forth, and just medical school. I was studying 12, 15 hours a day. It was really tough, and I decided I was going to put the brakes on medicine for some time and just kind of recalibrate. And because we already had a family of three at that point, and there was some risk taking, going to medical school and having to pass the board. So I had a long conversation with my wife, and I said, I think I need to go in a new direction. So my father, his dad, my grandfather, he was actually in property management in a small little community in Indiana called Monticello. So I kind of have that in my background, and I thought, I'm going to take a leap of faith, and I need to get something where I can produce income, take care of my family. And it was at the time when, a lot of people were starting to get into real estate back in 21, a little bit, while there was still COVID going on, but it was starting to kind of open up. The interest rates were falling. People were getting their real estate license. So I'm just jumped right in and never looked back since then. So it's been a great opportunity for me. And I always had an entrepreneurship background. I started a company, grocery delivery service beforehand. And so my father's a businessman. He started his own company in physical therapy. So kind of had that background already, but decided to make the move when when COVID hit.
It
So
seems like everybody, most of the people that are in either mortgage lending or real estate, it seems like it was never like the option coming out of school, right? Or it was never like the option for people that are young. Like no one ever says like, man, I really want to be like a mortgage lender or want to
yeah,
be a real estate agent. But it's because my story is very similar where you kind of know somebody that's in the business and then you're like, well, you start to think of it more as an opportunity, then you start to learn more about it and you're like, wait, this could be really good for a lot of different reasons. And then you just kind of make the shift. Like I went to school for computer science, but
yeah.
I did internships when I was in college at a mortgage company and my brother worked for that mortgage company. So then I graduated college and was like, not exactly the best, at coding, wasn't really my thing, but I felt like I didn't want a business degree because I wanted to be like more unique and just have like a different background. And then I'm like, yeah, I don't think I'm going to do this. I think I'm going to end up moving into the mortgage space. So,
And I think with
yeah,
your computer science background, you were probably very good at logic and reasoning. And I think that's a important skill set, especially with, crunching numbers in the lender business, would you
yeah.
say?
What's crazy is I thought for like the first couple years in this business that I wasn't using my degree.
Hmm.
But then I realized pretty quickly that I actually do use my degree like every single day.
Yep.
So for me, that was just like kind of crazy. Um, Hold on one second here. Okay, there we go. So yeah, I mean it's sort of funny how that happens, and then you start to become good at it. So you start to become an expert in it,
Yep.
and then you start to enjoy it more, which then makes you more of an expert. And then you kind of can get lost in that process, which I think that's probably part of what I wanted to talk about, was just some of the things that you've learned, especially, looking at it from the post-COVID perspective, that like you weren't expecting. Like for me, I didn't realize how little people knew about the process. And also, once you become good at something that you do well, you don't realize how much misinformation is out there about what you do.
Yep.
And it makes you realize that there's probably misinformation about what everybody does. And you're like, is what I'm reading right? It says it's from this expert. And then you're like, when you're the expert, you're like, no, that's not right. Like, where did you get
Yep.
that from? Which I think we'll talk about, like interest rates and stuff like that. And
Yeah.
a lot of that comes into the math and the interest rates. But
Well,
that's where you
even
see a lot of misinformation.
I was just thinking about before I got into real estate, even when I was just started, I thought that you always had to put, 20% down, this idea that that's the down payment. And then I started learning about FHA loans and even VA loans where there's no down payment whatsoever. So a lot of people don't even, if they've served in the military, that's a huge incentive for them to not have a down payment. And I wasn't aware of certain circumstances like that. I always thought, oh, we put a down payment's got to be 20%, and that's just a myth. It's not true. So,
Yeah, and not only that, it can often be the worst decision. And I think that
hmm
it's tough for people to get over that hump, because probably like maybe 2 or 3 times a month I talk to somebody and this comes up like, how much do I need to put down in order to avoid MI? I'm like, it's 20%. Now, there are other strategies where you're paying all the MI up front, your lender
is that
pays
like
it,
the
but
private
it's
mortgage insurance you're
yeah,
saying, PMI?
yeah,
Yep.
private mortgage insurance. But people are afraid of this because they feel like it's a waste of money, because it is technically a waste of money. Like, it
Yeah.
doesn't help you in any way as a homeowner to have mortgage insurance. It protects the lender, but they're so afraid of it. And oftentimes, especially if you have good credit, it's like 40 or $50 a month, maybe 60, maybe 70. But it's not like a large sum of money that you're just like throwing away. But then if you
hmm
were to run the math on how long it takes you to save up 20%, and sometimes I'll do this calculation with people. I'll say, well, how long do you think you would need to save up 20%? Like, oh, 3 or 4 years. Like, what do you think home value is going to be in 3 or 4 years?
A
Well,
lot
they're probably going to
higher.
go up. Let's say, so then you run the math, and I'm like, you're going to probably cost yourself like $37,000
hmm
trying to avoid like $50 a month. And then also, by the way, after you have owned the home for a few years and it's gone up in value, you just refinance and get rid of your PMI.
Yep.
So it looks like it's this big hurdle, but the biggest hurdle is the misinformation that you have to have this huge down payment, or
hmm
that you're somehow less worthy if you don't. And
hmm
neither one of those things are true, I think.
Yep. That's absolutely right.
Which is, now, what do you hear most from? So you're on the listing side, you have people that you represent as a buyer's agent. What do you hear most from, like, from the sellers? I'm always curious because I don't really work with sellers.
hmm
So, I work with sellers when they're buying, right? They may be selling and buying, but I'm not on the side of the table with them when they're, usually I'm on the buyer side representing them as
Yeah.
a lender. Like, what do you hear from sellers? Do they think values are going up? Like, especially when they're looking at listing their house, like, what's the biggest hurdle with a seller?
Yeah, that's a great question. So one thing is it's a microcosm. Every city and county, especially in Southwest Florida, is different. As you know, Tampa versus Sarasota. I mean, even Cape Coral was down 2.5% year over year in value of homes because of the hurricanes, because of the insurance. So a lot of people had their houses flooded, and so the prices went down a little bit there. But then in Naples and in Bonita Springs, house prices just continue to climb like 3-4%. So I think there's a misconception with the seller right away that maybe the value of their home is not what they thought it would be. But a lot of it's contingent upon where they're at. And even then, I think some of the hurdles you jump through is trying to give them an accurate valuation. A lot of times, and you may know this, that sellers have a high view of their house, and you have to just, warn them if they overprice, it could stay stagnant on the market. And then, of course, if that happens and you have to do a price improvement or price reduction or however you want to call it, that actually puts you at a disadvantage. So I try to encourage them to put it right at market value, or even if possible, just slightly under market value. So you get multiple offers and you organically bring that price up. Because if you overprice and underdeliver and it sits on the market for 60, 70 days, it can hurt you in the end. And I think that's, they always want to look for that outlier. And there is a possibility someone will overpay, but a lot of times their buyer agent is really good and they're going to do the research and they're going to find out that the home is overpriced. So I think that's one thing that I find is that they they tend to overvalue their home. I also encourage them to actually get an appraisal done. I say, look, you can get a comparative market analysis, you can get a broker price opinion from us, but the experts, the true experts in the field, are those who get appraisals done. And that way, if you're in a situation where you got a mortgage, right, you already have the appraisal done. And I don't know, maybe you could talk about this. Can they use that appraisal, or does the buyer agent have to pay for that appraisal to be done? I mean, I know that I just always encourage them to do that so that they have that in writing to show what the price of the home is,
Yeah. So like a new buyer, if you get a loan, appraisals, because of what happened in 2008, people steering values or working with appraisers and trying to get certain values. The appraisal process is just that. It's now like a process. So a
Mm-hmm.
lender has to use an independent third party appraisal management company to order
Yep.
the appraisal. The buyer has to pay for it. Then it ends up inflating the cost of appraisals to avoid this connection with the lender and the appraiser, or let's say a listing agent and the lender. So that conflict of interest means that now all buyers, if you get a loan, the lender has to order the appraisal. I may
Yep.
be able to transfer an appraisal from like lender to lender. If I get
Mm-hmm.
one and let's say I move that loan to a different lender for whatever reason, it might be to help the buyer. I can usually transfer that appraisal as long as I've ordered it, or another lender may have ordered it and transfer it to me if the loan is being transferred to me. But it can't be a scenario where like a non-mortgage lender, someone without an MLS number ordered an appraisal and
Yep.
then it stays with the buyer. But what you said about, I think this actually happened to me yesterday. So I was on the phone with somebody. I pre-approved her. She's looking at a house. The house is 599.9. Her agent told her not to offer less than 575 because the seller might see it as a bit insulting to their, like, they may not even counter. They may just say flat out no.
Mm-hmm.
And she may be willing to go up to 599, but she kind of wants to start a little bit lower. And what I told her is basically what you just said you do for your buyers, which is huge, or your sellers. You tell them to list it at the value that the house actually is, or maybe
Yep.
even a little bit lower, because now the buyer thinks it's been on the market for like 2 weeks. No one's like put an offer in there. No offer's been accepted. She thinks it's worth less than 600, and I think she's also correct. It's not a big house. 600 just seems like a lot for this area. So
Mm-hmm.
she's like, well, why would they list? Don't they have reason for that? I'm like, no, a lot of agents don't tell their sellers to list it at whatever they think it's worth. They give them this hopes and dreams price because in
Yeah.
certain cases, especially in Florida, it's happened in the past. And I'm sure you've caught wind of this maybe from another agent. It may have happened to one of your sellers where you just list something and some institutional buyer, cash buyer, someone just comes in and says, like, yeah, I'll buy it. I don't care if it's overpriced, whatever. They're like, I'm going to rent this out as an Airbnb. You're selling it to some large company or somebody that's moving in from another state that, in California, they're selling their house for 1.8 and they're
Yep.
buying a bigger house here for like 660. And they're like, whatever, it's worth 620. I'll just take it.
Yep.
And a lot of listing agents don't instruct their sellers that that's more of a pipe dream. That doesn't happen all the time, especially now as much as it did 2 years ago. And
Yeah.
if you just throw it at the wall and hope it sticks at 600, then it sits. You may end up at 550. Whereas if you listed at 570, you'd probably just get an offer for 570.
Yeah. I had a situation happen kind of similar to that. I had one in Cape Coral. This was maybe a year or two ago when we started seeing prices starting to fall slightly because the inventory in Cape Coral got really high after Hurricane Ian. So basically, we're kind of an anomaly. When you look at the housing market, it depends on, what's happening circumstantially. We got really hit hard by, being in Fort Myers and Cape Coral. But long story short, she put her home on the market at a price and she got an offer that was about 15 grand over what she was asking, under what she was asking. It was like they came in at like 245 and or 445 and she had it listed at 460. I told her, I said, look, in this circumstance, I would encourage you to take this offer. Now,
Yeah.
most of them would say, well, let's counter it back at the same list price And I just recommended that. Didn't want to make, she has to make the final decision, but I said, we're starting to see a downturn in the market. This may be the best offer you'll receive. We're not sure if we're going to get any offers after this. We had like 2 or 3 open houses and like hardly any showing. I think we had one person come through the open house, and we had 3 open houses, like, every weekend. So long story short, she decided, I'm just gonna go ahead and not accept this offer, and I think there's gonna be a better one that's gonna come through. So I said, okay, that's your decision. And so we waited, and we continued to wait, and we never got another offer. I worked diligently for her, and she ended up, unfortunately the listing expired. And then I would say a year later, she put it back on the market, and she sold it for under like 415,000 or 420. So basically, if she would have taken the offer at 445, she would have saved herself, almost 40 grand. So it's just
Yeah.
those kind of circumstances happen. And, you want to show them you have their best interests in mind. But I think a lot of times sellers may think, well, if we do a quick sale, maybe we're not being patient enough. And I can understand that coming from the seller's view too. But when we know that the market's in a downturn, that's why we kind of recommend you take that offer. That's how I feel
Yeah.
about
And a lot of that happens when you see rates rise.
it. Mm-hmm.
And that's usually an indicator that the market is taking a downturn. That's, in my opinion, one of the best indicators, because it does slow people down. It creates scenarios where people who want to move, and usually it's not as drastic as it was this time, but it still can be. So if I do a loan for somebody, and let's say it was
Mm-hmm.
2017 and you had like a 4% rate, just an example, they come back in like 2019 and they had a couple kids, and they're like, hey, we were thinking about buying. Usually they want to do the math first, like an existing
Mm-hmm.
homeowner does, more so than somebody who's buying for the first time. They're like, what would my rate be, and what am I going to be looking at here? And I'm like, well, you'd probably be at like a 5, and they're at like let's say a 4. And they're like, oh man, when do you think rates are going to come down? I'm like, well, I didn't realize it was going to happen in like 4 months and the world was going to take a massive turn. I'm like, I don't know, maybe a year or two. They give pause, and they're like, maybe not. So you get less sellers. You get less. Those people are also buyers, so it doesn't add to inventory because they're selling and buying. They're +1, -1. But even buyers that come in, I refresh everybody's pre-approval when interest rates change. So I
Mm-hmm.
reach out to the buyer. I say, hey, just to make sure we're on the same page, I pre-approved you 3 months ago. If rates are a half a point higher, I'm not going to have you go put an offer and come back to me, get excited, and then I tell you your mortgage payment just went up $200, and I never
Yeah.
told you. So I'll reach out to them proactively. They come back and say, well, now this is kind of giving me pause. So usually an indicator that you're going to have a lot less buyers is when rates go up. And so
Yep.
what you just said, that makes perfect sense. So you're seeing rates go up and you're figuring, okay, maybe we should just take this. Like, this
Mm-hmm.
isn't looking great. It's probably all over the news. Everyone's like, maybe I shouldn't buy a house. Like, just take the
Mm-hmm.
offer. Otherwise, a year later, you end up losing another 30 grand on top of what you already lost.
Yeah. And I think we find this too with how many showings we get, because typically, on average, we're going to get the best offer within the first 2 to 3 weeks, typically. And so when we don't get an offer for a month to a month and a half, we have to start talking about price reductions or price improvements. And that's why I think it's important to try to strategize right off the bat. And also, like, if you're in a community and let's say they're all like townhomes and they're very identical, maybe one has quartz countertops, the other one has stainless steel, or one has granite, but everything else is pretty much the same. Uh, Maybe some has, newer flooring, but let's say the ACs are very identical. And let's say one's listed at 320 and that's the highest listing. And the other ones are listed at, like, say 315 and 310. Where do you put your number? Do you put it in the middle? Do you put it a little bit under 310? Because they're going to look at all the houses and they're going to see, okay, if it's 4 or 5 grand off, you want to be almost at the lower end so that the person that's the buyer is going to accept that offer and you get under contract. Because we always say that when you're the highest listing in the community, you help the other sellers sell their property because you're the
Yeah, for
highest
sure.
listing. Does that make sense? I
Yeah,
mean,
absolutely.
now of course you list, if it's the highest listing and it's absolutely it's not the same and it's got more upgrades and it's got a better view, better location, absolutely you list it the highest, but I'm saying, if you can, like, sometimes we have cookie cutter townhomes that are exactly identical. And so that's when you kind of think about why you want to strategize that way, so that you can get the offer, not just an offer relatively quickly, but an offer that will be the highest. We had an investment property that was in the 380s, 390s just 5-6 months ago. Now they're in the 340s, 330s. So,
Yeah.
that just happens. If you would have, said put it at 375, you might have gotten in out of there before it dropped to 325, 330. So, but
It is it is quite literally. I try to explain this to people that people look at buying a house that they're going to live in as though it's an investment, which it is. It's an investment in your future, but
mhm,
it's not necessarily a financial investment. So the biggest difference is like a mutual fund is an investment. There's no 3 bedroom, 2 bathroom mutual funds. Like you can't live in a mutual fund. That's an investment vehicle that's specifically an investment. What you're buying, especially if you're going to live in it now, if you're going to rent it out, it's different. That's an investment. But you also
mhm,
have cash flow and all of those sorts of things. If you're buying a house to live in specifically because you think it's going to be the greatest financial rate of return with the least amount of risk, chances are you're probably going to be wrong. And the market functions a lot like the stock market in the way that rates went up, values, let's say, they didn't really go down, I don't think too much, but we do see some price reductions in a lot of markets. My
mhm.
opinion is part of that is listing agents that are listing homes for like the pie in the sky price more so than it is actually values going down. They're still going up. It's just you're not going to get 20%. Like you want to sell for 20% more than you bought it last year. Like you're still listing it at a normal margin above what you bought it for last year. It's
Yep.
just not this insane amount. So I think
Yeah.
part of that is people see price reductions and think like, well, the values are going down. It's just that the gain is going down.
That's a really important point. And the reason why is because I think, and it's hard in this market when you're getting a listing and you're talking to the seller, and they can persuade you sometimes to list at a certain price. And you So what I say is that's exactly it, because you don't look at the list price, you look at the sold price, but you look at the price reductions. And when the price reductions come down, it basically goes to what the market value was in the beginning. Let's say 3.5%. Because we're only seeing a 3 to 5% appreciation year over year. We're still seeing home values increase, but like you said, we're not seeing home values increase 20%. So a lot of times sellers want to list their home $100,000 over what they paid for in 2022, and that's not that's not as realistic anymore. You're
Yeah.
probably going to be at 25 to 30 grand over what you asked for in 2022. But I think that's a really good point what you made, because then statistically, kind of, people have to look at the sold price, the list to price ratio, not the numbers per se, because they can be too high on the list price.
Is that
So,
one of the hardest, like, because especially in this business, a lot of people have misconstrued expectations about a lot of things. Rates. I've had people ask me when the Fed funds rate was at zero, they thought their mortgage rate was at zero. So I mean, you really do get some like wild. You're like, nope, it's not. Rates aren't 0%. But is that probably one of the biggest things that you have to do? Like if you're working with a seller, is explain to them this. They're like, I think I have 180,000 in equity, and you're like, well, where did it come from? Like, well, I think it's just worth $100,000 more, and I put 80,000 down.
mhm.
Is that probably the biggest? You're like, it's really not. That you have to kind of then explain that it's probably going to be more realistic. Like it's not so insanely amazing.
Yeah.
And then kind of like then they maybe don't believe you at first, and then they want to like check with someone else, and then that other person doesn't know what they're talking about, so they tell them they do have it, and then now they don't know who to trust. I could see that being like a tough spot, especially when you're giving someone honest advice as a
Yep.
professional, that they're just
And
like maybe not.
and Josh, I want to tell you that we, as real estate agents, we're the jack of all trades and the master of none. And so what I do is I will talk to the title companies and I'll ask them to give the sellers a net seller sheet, breaking down insurance, breaking down their equity, breaking down their mortgage, because I'm not the expert in that area. I have knowledge in the mortgage industry, but I'm not a loan officer. I'm not a mortgage broker. I have experience in how title companies work, as far as an Alta statement, right? And making sure that the Alta statement is correct. But I'm not a title company expert. And so what I do, and I try to always coordinate with the seller to talk to the mortgage lender about their equity and to talk to the title company about what their closing costs will be. That way they are listening to, the experts, and I can give them sound advice, but I can't give them the advice you guys have. And I think that's why we all work together so well as a team, because we all need one another.
Yeah, and I've been on the side of the transaction where you have agents that don't necessarily take that approach, and they want to be an expert, I think for good reasons, because they want to feel very important to their
Mhm.
seller or to their buyer. And then sometimes they'll give advice, and then you hear the advice secondhand, and you have to tell them that it's not correct.
Yeah.
Like, no, that's not at all how it works. This is coming up a lot right now. So the Fed is cutting interest rates, right? So the amount of money it costs in interest for banks to borrow from the Federal Reserve, that's what the Fed funds rate is decreasing. They do that to spur the economy
Hmm.
because they're trying to, when they raise the Fed funds rate, the goal is to curb inflation, to kind of choke the economy a little bit. Let's make it more expensive to borrow. If we do that, we can slow the economy, which means we can slow inflation. We don't want a gallon of milk to cost $25, so raise the Fed funds rate. When they lower the Fed funds rate, usually you see, unemployment going up, you see inflation coming down, which it is. They lower that rate to then make borrowing more affordable to spur the economy. So that's happening now. So the Fed is kind of foreseeing that the economy is in a downturn and they need to cut the Fed funds rate. So the biggest misconstruction about that is that that is mortgage rates.
Mm.
So, and this every time the Fed cuts rates, it makes me a little frustrated because of the misinformation. Like undoubtedly, a number of people will reach out and say, "What are rates now? I see the Fed just cut." And then I'll go on social media and I'll see realtors posting, the Fed funds rate was this, your mortgage rate would have been this. Now it's this, here's your new mortgage rate. And
Yeah.
oftentimes what happens is the Fed cuts rates and mortgage rates go up because it's seen as inflationary.
Hmm.
Inflation and mortgage bonds are opposites. So over time, there tends to be a correlation. So when the Fed funds rate is low, mortgage rates tend to drop over like the course of like a year or two. But whenever the Fed cuts rates, a lot of times the rates immediately the day after go up. And so you'll get all these calls. They're like, I see the Fed finally cut rates. Whew, thank goodness. Like, what am I looking at now? Maybe $1,000 less a month. And you're like, yeah, it actually went up a quarter point today.
Went up.
And they're like,
Yeah.
that's the biggest piece of misinformation that is out there, is that the Fed
Mm.
cuts rates, mortgage rates drop. That's my version of trying to give realistic expectations to a seller,
Yeah.
where you're like, this, let me pull the math out and show you that this is not how this works. And
Can
they
I
come
ask
in
you
and make
something
it
on
more.
that, Josh?
Yeah, for sure.
So I had a question because I was interested when they started cutting, what was it, 50 basis points back in, was it September or August, September? And we
Yep.
did start to see the interest rates start to drop a little bit, right? And then all of a sudden in November, after post-election, now the economy, and I was going to ask you about that. How does that affect with the stock market? Because the stock market went really high. And then all of a sudden they cut another, what, quarter basis point, and people were surprised that the interest rates continue to climb. They're at, above 7%. And then what's the likelihood of, how does that all work together with a post-election, a new president? The economy is really, I guess the stock market had some big yields.
Yep.
What do you see? What do you see happening right now? Is that
So the stock market and the bond market, they used to up until COVID, and then COVID hit and everything went haywire. But they still do fluctuate inversely to one another. So
okay?
higher stock yield, higher stocks means typically lower bond yields. So that's because those investors, which tend to be people that hold your 401k, they could be the government, they could be Vanguard, whoever they might be,
Mm-hmm.
is investing that money either in stocks or bonds, let's say. Obviously, there's so much more that goes into it, but just to keep it simple.
Yep.
So if they're investing money in stocks, they're doing it because the prospect that the economy will do better is high. So
Mm.
whenever you see, for example, like a Republican president get nominated, the expectation is that is less regulation, which is good for the economy. It's good for companies, and therefore the market will boom. So you see stocks improve. The caveat is that that money is then taken out of bonds.
Mm,
So when COVID hits, a good illustration of this is COVID. So what the stock market does not like is uncertainty. Like, we don't know what's going to happen. So the
mm,
opposite of this happened during COVID. They're like, the world's shutting down. We don't know what to think. Take money out of these risky investments, the stock market, put them into bonds, put them into mortgage bonds. That's called a flight to quality. That is the act of saying, like, we'll sacrifice the prospect of a 15% return for the guarantee that we're not going to at least lose 30%. They're like,
mm-hmm,
we don't, this is too much of volatile. So just take the money out of here. That's why you see mortgage rates drop. So what happens when you see an election happen? They're like, well, the Fed's cutting rates, but mortgage rates are going up. Why? Stocks are doing better. It's because that flight to the opposite of that flight to quality is happening. Institutional investors are like, great. Okay, there's a Republican president. That means that the chances that the S&P 500 does well next year are probably greater than if it was the opposite. So take money out of this, put it in that. Less demand for mortgage rates. You need a higher yield to earn that same dollar.
mm,
So does that mean that it'll actually happen? It depends. Over time, I think what ends up winning out is what usually does, which is unemployment, inflation, the actual economy.
mm-hmm,
Putting a different president in, I think from our perspective is this massive difference. But the American economy has been chugging along for like 270 years. So yes, changing the president matters. All of those regulations, they do matter, but I think they matter over a long period of time.
mm-hmm,
And what is likely to happen in the short period of time is probably something similar to what would have happened no matter who was elected in terms of the economy. So, like, yes, over 10 to 20 years, one president versus another will make a big difference. But next year, I think that rates do come back down. I think that
mm-hmm,
unemployment does creep up. Hopefully inflation does come down because the Fed, the only thing that they really want to do right now is drop inflation. So I think they'll be successful in doing that.
very good.
So it's a bit nuanced, it's a bit complicated, but the general rule of thumb is like, if you see high inflation, you're going to see high mortgage rates.
Mm-hmm,
And if it looks like the economy is going to do well, you're going to see high mortgage rates. And that's just usually the way that it works. Now, Fannie comes in and buys mortgage bonds. So you can artificially subsidize demand for mortgages. I mean, there's a whole lot that goes into that, but just kind of in broad strokes, that's usually the gist of it.
mm-hmm.
So I
That's
think that
good.
rates will come down, hopefully.
Yeah, I hope so.
But it takes years though. Like, they go up for
Mm-hmm.
years and they go down for years.
Slowly,
So
right? They go up
I'll usually
quickly, but go down slowly, right?
yeah. So like I'll usually explain this to a buyer. They're like, when are rates like the expectation is oftentimes that like by the time we're going to get off this call, rates are going to be different than they were when we started the call.
Yep.
Like that's how quickly people think. Or tomorrow, rates are going to drop like a quarter point. If rates drop a quarter point in one day, something massive happened.
Mm,
Like even during COVID, the we would shut the entire country down and rates would go up and down. But like it usually wasn't the case that it would be more than a quarter point. So you're looking at like a 6.875 going to a 6.625 with shutting the country down. Like that's how
wow.
big the movement for like a day over day change. So like yeah, within a week they were a point lower, but that's just kind of just trying to show like how slow that process is. Like if when we talk in January, I wouldn't be surprised if rates continue to drop for the rest of the year and they're still only a quarter point lower in January. Like it just takes years, which is good, by the way. Brought no one like swings back and forth. It's too crazy for buyers, it's too crazy for sellers. So that stability, it is actually not a bad thing.
That's good.
So
Yeah.
that's kind of my position on it. So I'm going to leave you one more important question that I think, like we were saying when we started, a lot of buyers don't necessarily understand how the process works. They need experts that are both on the real estate side, that are on the mortgage side. And it's good that you know your expertise and you refer to people who know their expertise.
Yep.
So if I'm a buyer and I'm looking to buy, what's the most important thing? Let's say I'm in the Florida market, I'm getting ready to buy a house. What's the most important thing that I need to know, whether it be finance, real estate? What do I do first? Like, how do I figure this out?
Well, I think the most important thing is, you think about your budget and you get pre-approved. because when you get pre-approved through a lender, they'll give you a number. Let's say it's 500,000. You're approved for 500,000, so that when you're looking for homes, you're not looking at the $600,000 range or the 450. Maybe you qualify for more than what you think. So I always encourage them to say, "Hey, look, before we start seeing homes, let's get pre-approved, just so that you know kind of where the target is." And then once we do that, then you can start looking for location. You can look for whether you want to decide on doing a single family home versus a townhome versus an attached villa. Then we can start getting into conversations about homeowners association versus non-HOAs. I mean, that's huge here in Southwest Florida. Same probably up in Tampa area. Uh, you have places where there are pet restrictions. So that's obviously a very important component to buying a house. Is if you have pets and they allow it, then you're going to accept that community. If they don't, then you're going to move elsewhere. But I think the first step is being pre-approved, so you kind of know your price point. Then you can start thinking about location. I would also encourage them, to know what their additional costs are, like property taxes, what their insurance is, closing costs. That way they can talk to a professional. A title company can I always get the title company to give me a net seller sheet, so that I can tell the buyers how much they're gonna, or the sellers how much they're gonna net. And then I think about another important component to talking with the buyer about expectations is that when they get under contract, they're going to also be getting an inspection done, and that's going to cost them $350 to $400. And then if they're using a loan, right, whether it's a VA or FHA or conventional loan, as far as I understand, an appraisal needs to be ordered. So that's going to be an additional cost. And then escrow. How much are you going to put down? Typically, I tell them 1% to 3% of the purchase price. Um, and then the last thing I would say is for a buyer to think long term. So let's say they're a young family and they want to have a couple kids or 3 kids down the road. They may consider buying a 4-bed, 3-bath home, even though maybe they just have one child, but they know that they're, expectations for growing the family, so that when they buy at that point, it's going to be cheaper to buy then than it would be in 15 years when they have a big family. So those are kind of things that I would say, set your mindset for the future. But the first thing is pre-approval. What are your thoughts on that?
Yeah. The amount of time that we can win back by getting pre-approved early, people don't realize how small the differences can add up over time. It could be something as simple, and this happens with almost every pre-approval I do because I make a point to do it to show why it was important for you to get pre-approved early. So everybody that takes the advice, when
Yeah.
I talk to them and they say, "Well, I'm not looking yet," I'm like, "Please just go through it. We don't have to it's not going to cost you anything. It doesn't harm you in any way." Is like if you have like a 699 credit score, but if you paid your Chase card down to $100 instead of 150, your score would go up to a 700. That drops your mortgage insurance by, let's call it $14 a month, and maybe your interest rate by 1/8%, or it at least gives you some money back. If I
Mm-hmm.
add that out over 5 years, it's like $7,000. And I'm like, so the act of taking a couple extra moments when you have time and doing it the right way can snowball into like 7, 10, even much larger savings over a very short period of time.
Mm-hmm.
And you're not going to regret doing it that way. Also, when you wait too long, you will suddenly run out of time. You never see it coming. You never see the perfect house coming until you want to put an offer in on it.
Yep.
So you're like kind of casually looking, I think I'm going to buy, but maybe not. And then you're like, especially it's usually like the wife will, because it's more emotional typically to the spouse. They're like, we have to have this house. And then
Mm-hmm.
now it's a Thursday and you got to put your offer in by tomorrow. Now we're going into underwriting. You're scheduling moving trucks. Like you don't get all of this time that you think you have. And you can become ill prepared by not using it to the best of your ability.
Yep.
So that's my take on it is I like to do it, and it takes so much stress out. When all the financing's done before you even think you're going to look at a house, and all of a sudden the perfect one comes up, and we've gone through what you said where we send the loan estimate and go through the numbers. You go through all the important things on the real estate side. The title company has done their job. Now it's just about buying the house. It's
Yep.
so much less stressful. It's so much easier.
Yeah, and I
That's
think
what
it's good
I'm doing.
to set the expectations because maybe they are approved more than they thought. You know, a lot of
It
times
happens all the
people
time.
may have almost a negative idea of what their valuation is, and they become pleasantly surprised that they can afford more. And so that is already a optimistic outlook. You're working with the realtor now. The realtor showing you homes in your price range. The other caveat is, let's say you don't get pre-approved and you start looking at homes that are not in your price range, then you get pre-approved. Well, you had this expectation that is now not met, and that can cause you to get depressed or negative. And I think that's really the big key. And of course, you can that individual can get to there, but if they're not there now, they can't afford to make an offer for that property, and they may have an ideal view of what they can afford, but oftentimes, it's a mix both ways.
Yeah, the threat of the unknown creates it. It makes people make decisions they wouldn't otherwise make, and it makes
Mhm.
the process significantly more stressful, especially when they're in the process already, and they have these unknowns. Am I qualified? I'm like, I don't know yet. You should have called me a month ago, but let's figure it out. I see you've got your offer accepted because Quicken sent
Yeah.
you a pre-approval, and now your realtor's concerned that it's actually not real, and now you're self-employed. I'm like, well, they're calling you like, please figure this out for me, and you're like, you should have did this earlier. But so yes, I think that's a lot of insights. I think that we've covered probably more ground in an hour than I think a lot of buyers will know in their entire search for buying a house or selling a house,
I
which
wanted
is
to mention something too that you brought up about getting pre-approved, and what are your thoughts on this? I think that the buyer also has to be very clear where they wanna be. Like, let's say the location is in a flood zone and not in a I've seen pre-approvals done where they'll be pre-approved, and then all of a sudden, when they're in an AE zone and they're in a flood zone, I have to tell them it's gonna cost an additional 30 grand for them to get approved for that. And I've had some loan officers in the past pre-approve someone. I don't know whose fault it was. It could have been that maybe the buyer just didn't tell them that they were wanting to be in a coastal area. But I've had to actually tell that buyer they can't afford it now because you have to get flood insurance. It's required in that community because you're getting mortgage. Now, if it's a cash offer, it's different. But as far as I understand, and that flood insurance could actually throw them off for the loan, right?
yeah.
Because I've had that happen before, and actually, I think that buyer was upset with the whole situation, and they left the market. So they had this expectation that they could, but it was just a generalized pre-approval. Maybe it was a conditional letter, um, or
What probably
pre-qualification. So
happened
yeah,
is outside of if you have enough down payment or not, you're not pre-approved for a purchase price. You're actually just pre-approved for a monthly payment. Your
I see.
pre-approval is based off your debt to income ratio. So everybody now on the pre-approval letter, which I believe is a bit of a mistake, on most pre-approval letters and just the way that the industry is in general, it's like, well, what's the purchase price? Because you're not buying a house with a monthly payment, you're buying it for a certain number of dollars.
Mhm.
So the way the pre-approval is structured, or the way that borrowers assume they're pre-approved, is that they're pre-approved to buy a house up to a dollar amount, which is not the case. You're pre-approved for a payment up to 3,000. That $3,000 payment, like you mentioned HOAs, if you're on a golf course and you have $1,000 a month HOA, you're pre-approved for probably about 125,000 less because you have a
Mm,
thousand HOA compared to the equivalent house with no HOA. Then you
yeah,
start to throw in property taxes, insurance, flood
yeah,
insurance.
flood insurance. Yep.
So what the lender should always be doing is telling you you're pre-approved for approximately this purchase price. Whatever we want on the letter, we discuss as a team, the agent, me, the buyer. But buyer, please understand that you're pre-approved for this payment. This payment will change if you start looking at HOAs, if you start looking in different counties that have
Mhm.
drastically different property taxes. So
Yep.
your pre-approval can be in some cases 250,000 or 500,000 as long as you have enough down payment. So I think that's the biggest misconception is that they're pre-approved for a purchase price. And if the lender is not doing their due diligence on figuring out where they want to buy, which is why you should always have an example. I'm like, send me an
Mhm.
example of a house you're looking at. If all of a sudden they send me something on a golf course or like it's like in the ocean, I'm like, wait, this is different. I thought you were looking like Polk County. Like this is not the same as what we thought.
Yeah.
Um, you should be going through a real life practice run and example with the buyer, detailing that back out to the real estate agent so that everybody's on the same page. Because the last thing you want is a pre-approval that turns into no longer being pre-approved. But
Mm-hmm.
even worse is somebody who's now committed to buying a house that maybe they are pre-approved for, but had drastically different budget expectations for. They're like, yeah, you're pre-approved for 3,500 a month, but you were looking for 2,500 a month. Now you have
Mm-hmm.
this big lifestyle change, and you feel committed now, and you're like, what do I do now? I feel like I got screwed by somebody who didn't know what they were doing. Was it the lender? Was it the seller? Like who wronged me?
Mm-hmm.
So avoiding those mismanaged expectations is huge.
Absolutely.
All right, sir. So that was a great discussion. I appreciate you coming on. I
Yeah.
appreciate all your expertise and everything that you were willing to share. So certainly looking forward to doing it again. To everybody that was watching, thank you for tuning into Keys of Home Ownership.
Yeah.
Don't forget to subscribe and share this episode with anyone you think might benefit from it. And we'll see you next time as we continue to unlock the keys to owning your own home.